What did you make of those statements from Jeff Gundlach, some of the uncertainty investors are feeling right now? It really seems like, despite the fact that there were a lot of thoughts about a hawkish cut, people were just poorly positioned going into this Fed decision.
Yeah. I don't know if I might push back in the beginning to say poorly positioned. I think people are a little nervous because what an amazing year it's been here. Things get a little wonky here in the summertime in December. So maybe a little position squaring bonus locking in. The market came back, retested the 50-day average. I'm not that surprised. It was a very narrow range moving up. But, I listened to Jeff Gundlach pretty intently, and I hear his concern on servicing the debt. But I do believe bigger picture, we're in a secular bull market. I think this AI evolution, quantum computing, the cusp of what we're on gives us the ability to outgrow some of these concerns that we have with budget deficit. And, I think the concept of real rates has to come in here because, we're running 4.5% rates, but we have a persistent 2.5% inflation, which leaves you real 2% rates, which is the same thing it was 3 years ago.
Okay, so some of the things you're leaning on are the idea that we're going to see tremendous growth, whether it's quantum computing, the AI trade, et cetera. But what about some of the numbers that we've already gotten? Forget about what we're looking at ahead. Housing numbers that weren't great, non-AI chips that weren't great. I've been talking to a lot of traders, even talking to our Jim Crater. He says until that gets all the way priced in the market, it's going to be hard to find the bottom. Do you agree with that take? A lot of people believe that the bottom's not really clear, at least not this morning.
Well, I can't help but think back to the last CPI report. Reading from the BLS, they're saying 40% of the headline inflation was housing, right? And then if you look at the numbers of Toll and Lennar that just came out. Toll last week, I think it was like a 9% drop in backlog of homes. And then Lennar, their deliveries dropped 7% and new orders down 3%. So, 40% of the headline rate, we're already seeing signs. We just saw some building permit numbers and housing starts number come off. Like that is a key driver. That's coming off. So we might see some housing disinflation, maybe deflation working against that inflation fight.
Todd, you're clearly glass half full. A lot of people are tuning in today looking for some optimism, but I do want to come back to some of the reality of what we're seeing, especially when you look at the dollar. Dollar's up over 0.75% just this week.
Yeah.
Since the election, it's up more than 4%. Yep. Next year, we're looking at an earnings forecast of about 14%. Is it time to look at that and say, hey, maybe that's not as realistic with the idea that bond yields could even move higher? The dollar seems to be moving higher. And there's just a lot of inflationary policies on the table. We don't know if they're reality, but they're certainly on the table.
It's such an interesting conversation. And Frank, a long time ago, I was on a CNBC show called Money in Motion. I used to trade for an FX hedge fund through the yen carry unwind in 2008. People look at the dollar strength and immediately assign inflationary expectation from the incoming administration's policy, but I think it's a nuanced conversation. The dollar is being led higher against the yen, which is a carry trade, and along with the non-dollar yen crosses also going up, that's global macro managers putting the carry trade on. True, it came off yesterday, but Aussie yen, Euro yen, Kiwi yen, these are all risk-on barometers for the global economy, and along with dollar yen was those yen crosses moving up. So it's not just a blanket dollar inflationary higher yield story. The 10-year yield, we went up to 4.5. This is where we were, a month or two ago. We've backed off. We got down to sub 4% several months ago. That was too low for the strength of this economy. And the good thing is, if the 10-year yield keeps going up and the 2-year yield maintains, what does that do? That takes the yield curve further out of inversion, which that's the shape of a healthy economy.